And good afternoon. Welcome into Market Talk here on this Wednesday, April 6th. Great to have you with us once again. Thanks for making us part of your day. I'm your host, Jesse Allen. Find us online, markettalkag.com. That's our home on the web, markettalkag.com. Find all of our streaming sources there, our social media links, the latest news of agriculture, and much more. It's all online at markettalkag.com. Well, we look at today's action. We'll call it an inside trading day in grains. Fairly quiet, not a whole lot of movement. We were mostly lower, livestock mostly higher, but there's plenty of things swirling around to talk about. We have reports coming up here this week that we need to discuss and much more. Let's bring in our good friend Mike Zuzolo with Global Commodity Analytics joining us this afternoon. Mike, good afternoon to you, sir. And, for as quiet of a day as it was today on the grain and oilseed sector, there still is plenty out there to talk about, but at least it was a relatively quote unquote easy day compared to some we've had lately.
Yeah, I'd frame it that way too, Jesse. I think we had a somewhat risk-off day, led mostly by the outside markets, but the grains themselves seemed like they were pretty contained and feeling like the supply-demand fundamentals pretty equal in terms of news that's coming out that's supportive of tightening supplies and news at the same time maybe coming out with a little bit of an issue with the easing of demand. I think one of the things I noticed midday, especially as the stock market started to give way and the crude oil and the vegetable oil market started to give way, is that the soybeans looked a lot like they did after the acreage report and after the grain stocks report. And I think this makes sense heading into Friday's WASDE numbers. The most important thing for me on the WASDE number is going to be the world wheat stocks to use ratios. Does USDA frame this in the context of a burgeoning famine and potential biggest food crisis we've seen since 2011, maybe the biggest food crisis we've seen in a generation? Do they start to give us a heads up that Russia and Ukraine really are going to see a lot less exportable supplies for the 21-22 marketing year? Or do they keep things pretty much the same after reducing some in March? So world wheat stocks to use numbers are the most important thing for me in the big picture. The second thing right behind that would be the world soybean stocks to use ratios, because we still don't have a good idea of where Brazil sits. And we are starting to see some real issues crop up with, among other things, in the outside markets, the Chinese. And yes, we saw China come in and buy some U.S. soybeans on an export sale report this morning, or notice this morning, a flash sale for 21-22 soybeans, but we don't seem to be getting that consistent buying on the weekly export sales numbers that we need at this point. And I think a lot of that has to do with China having a real problem with their management of their COVID. And as a whole, their demand is starting to slow down pretty substantially. So I'd frame it this way, Jesse. I think wheat really could take a good report and do something with it in terms of lower stocks to use ratios. Beans, I think, almost need lower stocks to use ratios so that they don't maybe pull down the corn and the wheat at this point.
Well, Mike, I want to dive into a few things as well on the macro side. We have a lot of talk about the Fed this week. There's a lot of worry about them getting more aggressive. And I wonder, with all these reports in front of us and the talk of the macro picture, do we have some demand headwinds coming our way? What are your thoughts there?
Yeah, we do. And they're starting to show up. And in fact, one of the bigger agencies over in Germany, private forecasters that looks at world demand specifically in global trade, just came out today, the Kiel Institute, and said that, look, we're looking at about a 3% drop in global trade of goods by value. And I think this chart right here helps explain why that's starting to happen. Is you've got the Russian sanctions, you've got the Ukrainian war surrounding the Russian sanctions, higher crude oil prices because of both of those things. Central banks are tightening their money supply, and China's COVID policy, I think, can be really wrapped up in this chart very nicely. This shows you the 10-year U.S. bond yield chart compared to, in a correlation relationship, a 26-week relationship between it and the US dollar. Notice that it's got a positive 0.7 relationship with each other. And that 10-year yield, we have to remember, is the benchmark. That's the one that trade looks at, because that's what the Fed has decided is our benchmark to borrow off of and lend off of. Well, notice that 0.7. So that's about a positive 70% relationship over the course of a half a year on a running basis between those two. But more importantly to me, that 0.7 takes you to the highest level since 2017 2016 area. And that's when we really fought a lot of deflationary pressures when it came to the commodity markets, and what you specifically asked about, Jesse, the demand side of the equation. So why is the dollar at a May 2020 high right now? It's because these bond yields are flying super high right now. And why is that? Well, it's because the Federal Reserve and the European Central Bank are so nervous about this cost push inflation. They're tripping over themselves practically to raise rates. And the Fed did come out this afternoon and said, we'll probably do a half a point jump in May. Will also probably kick down or tighten the liquidity in terms of quantitative tightening by $95 billion a month. That's a big number, $95 billion a month. They're going to start tightening the purse strings along with a half percentage point rate hike. So this makes sense why the trade has been taking the bond yields up and the dollar yield. And as a result of that, we've lost about 26% of our value in crude oil prices since the March high.
Very, very true. Well, and I know as well, China is all a part of this, and I'll flip us over on the video to the other chart and explain what you're seeing here and how this ties into the macro picture and some of those demand headwinds here, Mike.
Yeah, this is from Kaixan, and they have a very good reputation. They're relatively new. They just started this about 2 or 3 years ago, but they seem to be ahead of the curve versus the National Bureau of Statistics when it comes to what China's actual economy is doing. This is kind of the engine or the RPM reading on China's economy. And I use this gauge as when you get to the 50% mark, that blue flat horizontal line, that's the difference between having good employment and having mass unemployment. And that's the difference between 5% or lower GDP, in my opinion, Jesse. And what I'm saying to you is when you go below 5%, 5.5% GDP in China, that typically really ramps up the unemployment, and all of a sudden the jobs are not there. And then you start to see their demand aggregately really slow down. Well, they're kind of in that situation right now by their own policy. And it's a real policy screw up, in my opinion, but it makes sense from a centrally planned top-down economy in terms of how it's managed by a communist party. Well, they're just shutting down, areas of Shanghai, Jilin. They're shutting down their major agricultural sector, their major financial sector. And this Kaixan report shows it. I mean, we're down at some of the lowest levels in terms of their services purchasing managers index in red. They're going down into the COVID territory at this point. And what I like about this chart, and this comes back to the commodities, I always try and bring all this stuff back to the commodities. This kind of shows you that pork and bean trade, in my opinion, why the funds like to buy beans and buy hogs, or sell beans and sell hogs pretty much at the same time this past year and a half. And it really does go back to China and how strong or how weak China is. So when you see a chart like this, it shouldn't surprise us that April hogs since the end of March are $10 roughly off their highs. May soybeans roughly $1 off their highs. This chart these two lines need to get back up above the blue line in order for the soybeans and the hogs to really find a lot of fund related buying, in my opinion. So this is I think a good leading indicator that soybeans are going to be an issue from an investor standpoint versus the corn and wheat in terms of what maybe will hold corn and wheat back. And maybe hogs will do the same thing in the summertime here as we get into grilling season when it comes to what the cattle market could or may not do in terms of upside potential. And I think that has been a big feature as to why the cattle market has stumbled here on really pretty solid supply numbers in the last couple reports.
Well, Mike, I'd like to get your thoughts on this. As we're sitting here talking and thinking about things, we just had the prospective plantings numbers and those big reports from USDA, and now we're coming back with an April WASDE. Tomorrow, Thursday, we have the CONAB numbers. I have to wonder, do you think with all of these, fairly important reports together, do you think the trade might chew up and spit out some of these numbers here at the end of this week? I mean, do you think the trade's going to lean more to what we saw with the acreage numbers and the quarterly grain stocks? Or do you think the trade will say, oh, these are more updated numbers here for the April WASDE? They're going to lean more towards that? Or is it just going to kind of look at it and shrug and move on? I mean, what are your thoughts and feelings about heading into this report and what we could see just with so much data here in a short amount of time?
That's an excellent question, because what we're talking about are macro headwinds. We're talking about a dollar headwind, a crude oil headwind, And we're getting to the point now where the demand could really be getting hit, not just because the high price is staying so high for so long, but some of these other things we're talking about. So that then enters into the picture. If you have headwinds in the macro side, then flat price, commodity investment, bullishness is maybe going to take a pause here and maybe just kind of leave the theater and walk around the block a while and wait to see until the smoke clears what's going to happen. And what I mean by that is that if we don't have clear macro and micro fundamentals supporting us, we could lose a trend in the commodities as a whole. And guess what? We go back to the spread trade, and that is going to be really hard to navigate. And so I think to answer your question is I could see a lot of spread trade around the report for the 2 or 3 days after the report. But then we go back to the stocks, we go back to the wheat conditions, we go back to the tight corn supplies, and we start trading the spreads in more of a bigger picture, more longer term mindset. So my sense is that the trade in Chicago feels very comfortable being long corn because of the fundamentals of not just the supply demand based upon what we get Friday on WASDE's numbers, but also because of the wheat conditions and because the southern corn belt's not getting planted as fast as we want it to. It's not doing bad. It's right around the 5-year average right now. But I'm starting to hear from clients in Kentucky. I'm starting to hear some clients in the deeper South, and other colleagues of mine are hearing the same thing, that this could get ugly pretty quick as far as falling behind this year, and we can't afford that. That's the whole point of these tight supplies. So when I saw a 30% good to excellent reading on the winter wheat conditions for the whole United States, and the trade was at 40%, I don't think we traded that for just 2 days. I think we're going to come back and have to trade that again. But will that be in the form of a hard red, soft red spread where the trade buys hard red and sells soft red because the crop looks so good in the soft red country and the hard red conditions look so bad? I think that's the kind of muddiness we'll probably have to go back to in these spreads. And it's not going to be as easy, I don't think, to hit price objectives like we wanted to, or like we were able to back in December, January, and February.
Very interesting thoughts, and I love your explanation on all of that. You mentioned those wheat ratings, lowest in over a decade for the initial ratings. I know there's some worry about that wheat crop moving forward, and in soft red country, we watching it with that drought and everything else, and be interested to see what happens with these market numbers moving through Friday's trade. Mike, let's go over to livestock. You talked about it a little bit, cattle and hogs. Today we were able to move a little bit higher with the stock market lower, grain prices lower. Hogs have had a rough go. Some people think that we put a top in that market. What's your thoughts on the hog trade?
I don't agree with that, Jesse. I feel like that the ham specials are just too good. I mean, I had a client call me from Indiana and told me they had 87-cent hams over there at Kroger. I feel like we found more HPAI in Iowa. I think it was Hamilton County again, and another commercial turkey flock. I feel like between the HPAI and just the great prices in the pork sector and the available supplies, I just don't see them backing down much as far as the cash consumer demand. The margins are not what the Packers want. I recognize that, and that's probably why we had to pull $10 off the price. But look at June hogs versus June cattle. There's only like a $7 or $8 discount in the June hogs. So yeah, it's up there, but that could also be argued that June cattle are too cheap. And I think that's where I'm at. Is to answer your question about the hogs, I think that hogs are fair value. I think cattle need to make a run to the upside here. And I think that's how I'd look at it, as opposed to the hogs pulling down the cattle at this stage of the game. We're still 7% light on year-to-date slaughter and year-to-date production in the hog sector and the pork sector. And we keep seeing cattle weights drop 1, 2, 3 pounds a week pretty consistently over the last couple months. So when I heard, and I'm going to jump from hogs to cattle to answer your question, when I heard 128 traded in cattle in the South this week, I thought, this is ludicrous. How could it be 128 when the Packers are reportedly making $250+ a head? Well, that 128 went away really quickly, and we were all of a sudden back to a 138 price action on Wednesday, in the cash market, as what was being talked about. So I really feel like the June fat cattle have probably a $3 to $5 discount to them. If they'd rally, I think the hogs would stay relatively flat because the Easter seasonal is coming to an end. But I think the bacon seasonal is going to stay very strong this summer. And I just think the pork supplies are tight enough that we should have a hog sector that finds support off of the cattle and kind of reverse what we've been trading with the cattle needing the hog support the past 6 months.
Now, a little more on that cattle trade. I was very surprised to see Monday and Tuesday trade in feedlot country. That's just we don't see that very, very often anymore. And so that made me feel like this is maybe an oddball week in cattle, just with some of that early trade in cash country, Mike.
Yeah, and I think this goes back to I believe that the demand we've talked about weakening demand unless the stock market really unravels. I think a break back in the crude oil prices would actually be very supportive for the meat consumption as we enter summer grilling season. The biggest thing that bothers me about the cattle side of the equation and the meat side of the equation is the dollar. Like I said, we're up at the highest level of the dollar index since May of 2020. Fortunately, the Chinese currency is very strong and the Brazilian currency is very strong, so it's mitigating this dollar strength. But if we would see the dollar really take off against a lot of our biggest importers, or if we ourselves would be able to import more and our buying power would increase, that would concern me. But right now, we don't have that issue. So to get to your point about trading in feedlot country, I think we're short bought in the cattle market right now as we get ready to get into that summer grilling season. And I think we'll find that out here in the next week or so as to whether that's true or not. I said it on another station today. I really feel like we should be more like 140 cash trade heading into April, May, as opposed to 130 cash trade. And I think that goes back to the supply demand fundamentals. As long as we don't see the dollar break higher sharply or the stock market break lower sharply, a crude oil pullback is probably exactly what we need right now.
Well, Mike, great analysis as always. Got a couple minutes. Any other final thoughts? Anything else you want to reiterate, or anything else we haven't touched on today you want to mention?
Yeah, just to cap off what we've been talking about, I still feel like we're in a wheat-led market, Jesse, especially with those crop conditions. When I went back and looked at the crop conditions, the last time we were at 30% good to excellent was back in early April of 2002. We were at 31%. That yield for winter wheat that year was 38.2 bushels. I think my 5 bushels off the all wheat yield that you and I've been talking about is right on the money still. So I still think wheat's the leader like 2008. I think the cattle and hogs are shaping more up to be more like 2014, 2015 in terms of upside potential, as long as we don't have a corn belt drought. Last thing I'll say is on this weaker energy market, this is really the time to have your head up and talking to your advisor, talking to your marketing guy, your fuel guy, get your summer needs locked in during this pullback, get your fall fertilizer needs locked in during this pullback. This Russian war is not going to go away anytime soon, if you ask me.
Great thoughts there on that as well. Mike, I know if folks need some advice and they want to look at your research, they can very easily do that by going to your website, can't they?
Yeah, please go to globalcomresearch.com and try and cash flow $150 for a 3-month subscription to all the analysis except for the text blasts. And if you want the text blasts of when I pull triggers and make recommendations and they come to your mobile phone, call me and we'll work something out. But I really think this is the time to do it. Try us out and see what our analysis can do for you.
Well, Mike, we appreciate the time as always, sir. Thanks for joining us on this Wednesday. Have a great week, and we'll talk to you again next week.
It's great to be with you as always, and thanks for having me, Jesse.
Mike Zuzolo with Global Commodity Analytics. Again, you can learn more Global Com Research, com with 2 M's, globalcomresearch.com. That's going to do it for the show on this Wednesday, April 6th. Find us at markettalkag.com. I'm Jesse Allen. Have a great afternoon.